Hello my dear students. In my previous video I had explained about the capital structure theories, and in that I had started with net income approach, and I had given you the format of that, and we had taken up one problem on that, and we could find out the overall cost of capital. Now when we talk about the net income approach, there are some assumptions of this theory or of this approach. It says when you are calculating the overall cost of capital, the cost of debt should be less than the cost of equity. So here we have 10% and here we have 12.5%, and hence the cost of debt is less than the cost of equity. And next, when we are increasing or decreasing debt capital in the capital structure, this cost of equity has to remain same, it will not change. So today we are going to find out, when we increase the value of debt from 2 lakhs to 3 lakhs, how will it affect the value of firm, how will it affect the value of firm, which is V. And then we are going to see how will this increase in debt affect the overall cost of capital. Then we are going to decrease, like we have 2 lakh rupees here, now we are going to decrease it to 1 lakh, and then we are going to find out the value of firm, and then we are going to find out the overall cost of the capital. We are going to see how increase and decrease in debt capital will affect the value of firm as well as the overall cost of capital. We'll start with this. Yes, in the previous problem we had started this one. The company's expected annual operating income, that's EBIT, is rupees 50,000. The company has rupees 2 lakhs 10% debentures. The equity capitalization rate KE of the company is 12.5%, and we had solved it by this. The value of debt is how much? The value of debt is here 2 lakhs. Now net operating income, we are starting with this, it is 50,000, which is given here in the problem. And then interest rate here is interest rate on 2 lakhs, interest rate on 2 lakhs. Fine, interest rate on 2 lakhs is how much? It is 20,000. So 50,000 minus 20,000 is how much? 30,000. Then we have the value of equity, sorry, overall cost of equity, that's the equity capitalization, it is 12%, right? That is 0.125%. If we divide this NI by 1.125, we are going to get 2,40,000, which is the value of equity. The value of debt is given in the problem, it is how much? It's 2 lakhs. So 2 lakhs plus 2,40,000 is 4,40,000, and hence we are going to get the value, overall cost of capital K0 is equal to EBIT divided by V. EBIT is here 50,000 divided by V is 4,40,000 into 100, we are going to get 11.36%. Now we see, if we are increasing the value of debt to 3 lakhs, how will it affect the value of firm? Fine, EBIT will not change, EBIT will remain same. It is how much? It is 50,000, right? And then we have interest on, here we have now, instead of 2 lakhs we are going to take 3 lakhs. 10% of 3 lakhs is how much? It is 30,000. Fine, it is 30,000, and we are going to get now NI value. How we are going to get NI? 50,000 minus 30,000 is how much? It is 20,000, right? So we are going to get 20,000. Value of equity is how much? Equity capitalization rate is how much? It is 0.125%, right? It is given the problem here 12.5%. 12.5% is how much? 0.125%. When we divide 20,000 divided by 0.125, we are going to get how much? Let us take it here only, is equal to this value divided by this value. We are going to get 1,60,000, right? And debt value is how much this time? It is 3 lakhs, right? 3 lakhs. So we are going to add these together. How much? 3 lakhs. It is here 3 lakhs. Fine, 3 lakhs plus 1,60,000 will give us the value of the firm, that is V. Here this 1,60,000 is what? It is the market value of equity, and 3 lakh is the market value of debt, which is represented by B. So total is how much? 4,60,000, right? 4,60,000. Now if we had to find out the value of overall cost of capital, overall cost of capital is equal to, we have EBIT divided by this is how much? It is how much is this? It is 0.109%, right? If we multiply it by 100, it will be equal to 10.87%. Let us round it off. We'll see how much we are going to get. We are going to get 10.9%, right? Now see here, the overall cost of capital has come down from 11.36% or 11.4% when we round it up to 10.9%. And the value of firm, if we see the market value of firm, it was earlier 4,40,000. When we increase the value of debt, it is now 4,60,000. And also with this, the overall cost of capital has come down. Fine. Now we'll see if we are decreasing it to 1 lakh. If we are decreasing it to 1 lakh, what would be the value? Fine. What would be the value of firm? Now again here EBIT will remain same. EBIT will not change. So let us take it 50,000 only. 50,000. Fine. Now 10% on 1 lakh is how much? It is 10,000. Fine. Now earnings available to equity shareholders, how will we get this? 50,000 minus 10,000 is how much? It is 40,000. Fine. And the value of equity will not change. Value of equity has to be same. It will not change. So next what we are going to do? Next we are going to find out the market value of equity, which is represented by S. How will we get this? Net income divided by KE. Net income is 40,000 divided by 0.125. So we are going to get 3,20,000. What is the value of debt which is given? It is 1 lakhs, right? 1 lakh rupees. Now the total value of the firm, or the market value of firm, which we represented by V, is equal to S plus B. S is how much? 3,20,000. B is how much? 1 lakh. So we are going to get 4,20,000. Am I right? So 4,20,000. Now we are going to find out the overall cost of capital. Overall cost of capital is equal to this divided by this. Am I right? Into, we'll multiply it with 100. Fine. So we are going to get 11.9%. Now if we see here, when we have decreased the debt capital from 2 lakhs to 1 lakhs, the value of firm has reduced from, it has decreased from 4,40,000 to 4,20,000, and the overall cost of capital increased from 11.4% to 11.9%, right? We can now say, when we are decreasing the leverage, there will be increase in the overall cost of capital. But with the increase in the leverage, that is with the involvement of more debt, the overall cost of capital reduces with increase in the value of firm. Thank you so much for watching this video.